Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. Let's take a look at this session that's just played out overnight, and we've got a bit of a pullback. Looking at S&P 500, lower by 0.3%. The tech-heavy Nasdaq down 0.1%. And that is pulling back from fresh all-time highs we got last session on Thursday. And looking at what is playing out for the Dow, we have also the Dow Jones Industrial Average lower by 0.5%. Now let's check in with Sam Konrad. He is the investment manager for Asian equity income for Jupiter Asset Management. Sam, good morning. How are you doing today?
Good morning. I'm very well, thank you. Great to be with you.
Great to have you on. Happy Friday. Let's talk about what's playing out in the markets these days. And we are looking at quite a choppy few days, especially with what's been going on with the backdrop of the tariffs as well as the U.S. government shutdown. What are your main takeaways reading into the market signals right now?
Yes, you're right. Clearly, there is a lot going on. The economic signals in the U.S. are mixed, but we still think the U.S. economy is broadly resilient. It does look to us as though the Fed is likely to continue to cut interest rates, and that should be supportive for equities. But clearly equities have already run up a long way in a fairly short space of time. But we are broadly positive looking into the rest of the year, but we think the risks are actually lower if you're looking to invest in Asian equities than US equities. Okay. So we manage an Asian equity strategy, and we are still positive about the outlook for Asian equities. And year to date, Asian equities have actually already outperformed the US.
Yeah, we are seeing some momentum going through or playing out for Asian markets. What's driving this optimism in the region?
Well, one of the key things for Asian equities is you get a lot of diversification, whereas if you're looking to invest in the US, clearly it is very much dominated by tech, whereas in Asia, yes, we do have a very strong tech sector that we actually still think is a little bit underappreciated, particularly in Taiwan, but we find more attractive valuations for the Asian tech stocks. But beyond tech, we have a lot of other sectors and countries that we think are very attractive. So we really like Australia. We really like investing here in Singapore. We think the Korean market is attractive. And within emerging markets, we do like India. And all of these different parts of the Asian equity market are very different to each other. And that diversification is attractive to us.
Yeah, Sam, you mentioned Singapore. What are some of the names that stand out here?
But we think a lot of people ignore Singapore, and we think that is a big mistake. Here in Singapore, we own DBS. We think it's the best, the big banks. We own Singtel. That gives us exposure not just to the domestic Singaporean telco market, but actually they own stakes in businesses in India, Australia, Thailand, Indonesia, the Philippines. We own ST Engineering, which we think is a great company. They are a defence company. There's very few high-quality defence companies we think that you can own anywhere in the region. ST Engineering does stand out to us. We own a REIT, the largest REIT, so CapitaLand Integrated Commercial Trust. We like their retail assets, their office assets. We think arguably the retail and office property markets in Singapore are two of the most attractive retail and office markets in the world. And then finally, we own Genting Singapore, who of course own Resorts World Sentosa. So there's 5 companies that are very, very different to each other, but they all, we think, have good management teams, strong balance sheets, good corporate governance, and we think they will be able to grow their earnings and grow their dividends over time.
Yeah, and of course, the Singapore market has been hitting new highs in recent weeks. So let's talk about what else around the region you are looking at more closely. It looks like India and Taiwan are some of your key overweight positions. Walk us through how investors should be thinking about these markets.
Yeah, so Taiwan for us is all about tech. We don't want to have exposure to the Taiwanese domestic economy, but we want to have exposure to the world-class tech companies that you can find in Taiwan. Clearly, the most well-known is TSMC. It's the largest stock in our portfolio, and we think it's arguably the most important company in the world, and you could also argue it's the best company in the world. And we do think that the valuations of the Taiwanese tech companies that we own are attractive both on an absolute basis, but also relative to the US tech stocks, but also relative to other sectors as well. And then when it comes to India, we're not actually overweight India right now. We are slightly underweight. We have been overweight in the past. But for us, it is the most attractive emerging market in Asia. And we do think that the long-term outlook for India is positive. We actually prefer to invest in developed markets in Asia, which does differentiate us a little bit. But India does stand out to us as the best emerging market in Asia.
Sam, just to pick up on a point on TSMC, you mentioned it is in some quarters described as the best company in the world. What makes it so?
They have been able to create a manufacturing system that no one else has been able to match. So their key competitors are Intel and Samsung's foundry business. And although both Intel and Samsung can buy the same semiconductor manufacturing equipment as TSMC, no one else has been able to create the manufacturing ecosystem to match what TSMC has been able to do. So they have a more than 90% market share in high-end semiconductors. So the likes of Apple, Nvidia, they could not make a single one of their products without TSMC. And essentially any high-end technology product that you or I consume or businesses consume, it most likely has a semiconductor chip that is manufactured by TSMC. And that means that their growth outlook is very positive. They have very strong margins, very strong balance sheet. Their management team are very impressive. And we do think it is more important to the tech economy globally or the tech ecosystem than the US companies.
All right, so it's built a nice moat for itself. All right, let's talk about China, where the World Bank has in recent days raised its growth forecast for the country to 4.8% from 4% just 6 months ago. How are you approaching China right now?
So we don't have any companies in our portfolio in mainland China. Now, clearly this year, Chinese equities have had a rally. And when we look back historically, there are periods where Chinese equities do have a rally. But then they normally give that back quite quickly. And so if you look over the longer term, over the past, say, 30 years, Chinese equities have actually been one of the worst performing equity markets in the world. And that's despite pretty strong economic growth. So you mentioned an upgrade to growth forecasts in China. But when we look at China, we do not find a strong relationship between economic growth and earnings growth for the listed corporate sector. And that's in stark contrast to what we see with India, where there is a strong correlation between economic growth and earnings growth. And we think that is because of the political and the economic system in China that is dominated by state-owned enterprises who are not in existence with the primary motivation to maximize shareholder returns. So we actually think the outlook for the Chinese economy is still fairly muted. We think there are far more attractive places to invest with lower risk outside of China.
All right, not a strong correlation between markets and the economy when it comes to China. And we've been in conversation with Sam Konrad. He is the investment manager for Asian equity income for Jupiter Asset Management. Sam, thank you for your time. We'll keep it here today. We'll catch up with you again soon.
Pleasure. Thank you very much. Have a great day.
You too. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3.